When I arrived in Ottawa, coming from Vancouver and looking at the real estate in Ottawa, I was just like, holy smokes, real estate, it's so cheap here, yet the rent is almost the same as Vancouver. And this is like long time ago. So it was like an easy peasy decision for me to rent out my condo to medical students and then collect some cash flow. And I really was like on the real estate bug. Like I really wanted to go buy my next rental property. So I went out and bought a multi-family unit. It was a triplex, okay? A triplex. It was a 1960s home. It was not that great of a condition. And boy, it was a pain in the butt maintaining that property because I was too cheapskate. Well, really, I didn't have a lot of money back then to get a property manager. So I put in a ton of sweat equity and spent a lot of weekends renovating that property and then renting it out and maintaining the property. And there was like a lot of things I learned from that property. So I soon realized that multifamily units are just not my niche when it comes to real estate investing. In today's video, I want to go through the more common strategies for real estate investing. There's lots of real estate investing strategies. So I want to give you some lingo and straighten away for you and give you the pros and cons when it comes to each of these real estate investing strategies. So if you are an aspiring real estate investor or you're already really into real estate, then you got to check out today's video. Hey everyone, be sure to check out the link below to get your copy of Streetwise Mortgages Best to Invest 2021 market research of the top 18 investment markets across Ontario. Hey everyone, are you watching this video and haven't subscribed? Why not? Like I love talking about real estate investing and stock investing. I've been doing it for like a long time. And I like cover it in as little as minutes for you guys. So please hit the subscribe button and that bell notification so you get the latest and greatest videos coming to you. Let's get back with the video. Now, the first strategy I want to talk about is pre-construction condos, which is really another way of investing real estate in starter homes, but you buy a property before it's built because, well, it's easy to do. Literally, you just get contacted and they're like, hey, you want to go buy a condo? And they're like, okay, sure, I'll go see it. And all you do is buy it off a plan. And then a couple of years later, the condo's built and then boom, you put in some tenants and you rent it out. Is it really that easy? Well, I'm going to tell you the reality of it. Let's talk about the good points about this. First, it's super easy to do. Like there's a low barrier of entry. You don't need 20% down payment. You only need like as little as 5% down, but then you do have to fork over 5% and then maybe the next 5% after that. So you can pay in increments until you get the full condo when it's fully constructed. And then it's easy to buy and then you get financing and then it's easy to sell because if you're in a hot housing market, these condos can like flip into like much higher values than what you initially bought it at. But that's what they sell you. Let's talk about the reality because I've actually had many condos in my real estate investing journey and I'm trying to downsize it. And there's a reason why. Well, the biggest reason is that when you buy a condo, you really don't have any negotiating power when it comes to the price of the condo. You literally have to buy it at that price on that plan. So just think about it. A developer and the people like working on the ground who's doing construction, they all have to make money. So they're going to cost it out, the cost of the land plus the cost of construction, and then they add in their profit margins on top of it, and then that's what they sell at you. It's not really what the rest of the market's actually willing to pay. So you gotta really ask yourself, is it a good price? You really want to actually undervalued condo. That's going to be really hard to do with a pre-construction condo. So this is actually a much more speculative real estate investing strategy, which is buying a pre-construction condo off of plans. Second thing, another bad point is that condo fees, they can literally rise up super fast, okay? If I had this like countless of times where I'm like, hey, the condo fees are super low when I buy initially, but then they triple in price because there's so many amenities. Like if you have a pool, you have a hot tub, you have a sauna, and then you have a weight room. If the list goes on and so on, that means there's just more maintenance. So eventually condo fees can skyrocket, and that really, really eats into your cash flow. So all I'm trying to get at is just want to share my perspective. There's the good and the bad, but I would say condo investing, pre-construction condo investing is more a speculative real estate investing strategy, but has a low barrier entry. I would not recommend you doing that if you are a new investor. Okay, now the next real estate investing strategy is buy, you live in it, and then you convert to a rental unit. So literally it's like very similar to just buying a rental property, but you convert the property that you're living in into a rental property. This is like my favorite strategy. So let's talk about the good and the bad about it. Well, the good news is that you don't need a huge down payment. You can literally start with a 5% down payment, go buy a property that you actually want to live in, put in some sweat equity, meaning like blowing it up, and then all of a sudden leave and then convert it into a rental property, because you've done your due diligence, you checked out what type of rent you can get, and obviously covers all the expenses and cash flows. So then all of a sudden you just rein in the money. But let's talk about the reality of it. Okay, the downside is that this is not going to be your dream home. Okay, it is going to be a property that you have to put up with for maybe a year or two, and then you're going to have to move out really often. I would say this is an awesome strategy if you have a very low down payment. You don't have a lot of money, but you want to acquire more and more rental properties during your journey. This is a great way to get in, but there's a reality where you're going to have to move out more often. You're never going to live in your dream home. At least you're going to be delaying that gratification. And the third thing is that it's going to take a ton of sweat equity, because usually if you don't have a lot of money and put in a smaller down payment, it involves more time to really renovate and bling up that property. Even if you have a construction crew and outsourcing it, it's still a pain in the butt. But I would say it's an amazing strategy for new real estate investors who don't have a huge down payment. A great way. Just do it every couple of years, rinse and repeat, and you'll be soon on your way acquiring a bunch of rental properties in your portfolio. In fact, that's how I started. Thanks to Dahlia and her team, I've been able to scale my rental property portfolio fast. I had 8 properties at one point. Now, please don't make my beginner's mistake of going straight to the banks for financing your rental properties, especially if you're looking to scale your rental property portfolio. Now, trust me, the rules are completely different from financing a primary residence. And if things are not structured properly from the get-go, you will eventually hit a financing wall where the banks will say no, or you'll be required to pay a much bigger down payment for financing your rental property, which is like, boo. Even as a self-employed business owner, I've been able to finance my rental property portfolio, and at excellent terms. If you are looking to build a rental property portfolio, you must talk to Streetwise Mortgages. The team will help you develop a financing roadmap, including where will the money come from, how to structure properties to enable growth. Check out the link below. Be sure to book your complimentary consultation session with Streetwise Mortgages. Let's talk about the next real estate investing strategy that a lot of people do, which is small multifamily units. In fact, my second rental property was a small multifamily unit. So you could buy a duplex, which is 2 units. You could buy a triplex, which has 3 units, or you could buy up to a 4plex, which is still considered residential. So you could get a pretty competitive mortgage, get great financing, because it's not a commercial property, because anything under 4 units is non-commercial, it's not commercial. So the good side about it is that, well, you have more units, that means you have more rent coming in. And if any unit becomes vacant, well, the other units can, fulfill it. Basically, you're not going to be strapped for cash because you have other rental income coming in to help pay off your mortgage and give you a bit of cash flow. There's another good point about small multifamily units. I think it's an amazing strategy if you are a new real estate investor or an aspiring real estate investor to get into the game of real estate investing without putting a ton of your money in. Now, initially, of course, you need a down payment, but if you move into a small multifamily unit, you can literally have all your tenants pay off your mortgage. You could live for free, essentially, like live mortgage free. Like, even though you have a big mortgage, your other tenants are paying it. So that's an amazing, awesome strategy for someone who wants to get into real estate investing early on in their journey. Now, but let's talk about the realities. Well, the realities of owning a small multifamily unit, well, it's going to cost more money, okay? Because it's got more units, it's going to be bigger down payment. Second is that those type of units are purposely built for investors. So if you were like looking, if you own one of them and then you want to sell it later on, you're not going to get a lot of emotional buyers, okay? You're going to attract investors who are looking at it like from a numbers game. So you got to be sure to make sure you get the right rent so you can sell at the right price, because it's not going to be based on comparables of single family homes. You're not going to get the same, you know, huge boost in appreciation in some of the hot housing markets like we have in Ottawa today. Another thing is that these types of units can get pretty dinged up, okay? There's a lot more wear and tear because there's just more units. So these units, these small multifamily units can be actually on average way more higher maintenance than a starter home, like a single townhome or a condo investment. But I think this is a great strategy for someone who's an aspiring real estate investor and wants to get in and get in pretty cheap. As long as you have the down payment, you can literally like get it and live for rent free. Okay, that's like amazing. Now let's talk about the most traditional way of real estate investing, which is buying a rental property and then renting it to tenants, holding it, and then selling it at a later date. So what's the good and the downside about this strategy? The good news is that, well, the barrier of entry is pretty low as long as you have that big down payment. You do need 20% down payment. You can buy a townhome or a condo or any really starter home. I would stress, actually, I really encourage to have it freehold, because that's going to just, you know, you're going to get more cash flow. You're going to get more, you know, cash flow in your pocket after paying all the expenses, because you don't have to worry about condo fees. And this strategy is like super easy to finance, okay? Because it's like an easy peasy way to invest in real estate, and it's really easy to rinse and repeat. But let's talk about the downside. Okay, when it comes to buying like starter homes, it can be very difficult to find a cash flowing property, okay? Because you have to buy it at the right price, in the right location, in the right city, attract the right tenants, and of course have the right amount of money to maintain it with the unexpected expenses that could come up. But so that's the downside, that it's going to be really hard to find in some cities. Like in Ottawa, it's actually getting pretty hard to do. Now there are some gems out there, but I would say it's not easy as it used to be. Definitely 5 years ago was a lot easier to do this. You could say that 10 years ago. Vancouver is like next to impossible. Toronto, don't even think about it in the greater Toronto area. I would say that, but there's always pockets, as long as you just are willing to look a little bit further out. But the other downside is cash flow. See, some of these rental properties, they'll have unexpected expenses. You have a furnace maintenance repair, you have a furnace that blows up, you have the roof that needs replacement. It's like any other house, it has maintenance expenses. And when that happens, it could really kill your cash flow, because in the beginning, you're not gonna get a ton of cash flow. Sometimes you just be break even. And I've had it countless of times when I was in really early in my real estate investing journey. I was just like cash flowing like $100 a month on each of my properties, or sometimes just break even. I mean, depends on what the market's like. Or sometimes I was losing cash. So the thing about it is that don't rely on the cash flow, okay? When it comes to single family homes or starter homes, really, you're not in it for cash flow. It's really good for real estate investors who have another job and they just want to supplement with an asset like real estate. So this is a much easier, I think it's the easiest way to invest in real estate. It's just harder to find cash flowing properties, but it's a huge wealth generator if you buy the right property at the right price in the right location and attract the right tenants. Now, the last real estate investing strategy that I know a lot of people have gone into is syndicated mortgages. And what that really is just you loan money and it gets pooled and it gets lent out to developers or someone else to get a mortgage. It's really private lending, but you're pooled with other investors. So that's why it's called syndicated mortgages. Now, what are the good points and the bad points? Well, the good points is that it's really easy to do. You can find actually quite a bit of companies that does syndicated mortgages, and then they literally take your money, pool it, they underwrite, they basically appraise the property that comes in, the deals that come in, and then they loan it based on a certain percentage. So it could be 70% of the loan, they'll take your money and other investors' money and then loan it out to another investor. And then you get a little bit of money every single month or every single quarter, or you just get a bit of money at the end of 3 years. Now, it seems pretty passive, so this is the good side. Super passive, super hands-off. But let's talk about the reality of it. Okay, the reality is that a lot of syndicated mortgages have gotten a bad rep. Okay, there's been lots of legal lawsuits because apparently, you know, coming up with a syndicated mortgage fund is actually pretty easy to do. So I would be really, really cautious and ask you to really check out those companies and get the track record, like really seriously, because there's a lot of legal issues with them. There's a lot of illegal money movement. So you really need to know and really trust the company that's doing syndicated mortgages, and be sure to know that your money is super safe with them. And the interest rates, honestly, I would say it ain't that impressive, okay? We're talking like sometimes I've seen as high as 11% ROI. Now, I think if you could get into shorter time frames where you could flip your money within 6 months, maybe they'll give you a higher interest rate, but to me, I don't think it's worth it. Personally, I don't recommend syndicated mortgages unless you have a great relationship with the company, you've been in the company for a very long time, and you know you can get your money out because you've done that before, then sure, go for it. But otherwise, I don't think it's a great strategy, especially for new real estate investors. And even for me, I'm super against syndicated mortgages now. Anyways, I hope you found this video super helpful in learning first terminology and understanding the many different real estate investing strategies so that you know the pros and cons with it. Everyone, if you like this video, please give me a thumbs up, smash it below. It'll really help the algorithm. Thank you.